Hey everyone, and welcome to the Deep Dive. Ready to jump headfirst into the crazy world of the stock market?
Always.
Today we'll be trying to figure out how stock prices are determined and those wild things, stock market bubbles.
Right. Absolutely.
And we can't forget those derivatives everyone always talks about.
Oh, yeah, those are important.
We'll learn about things like the greater fool theory
Yeah.
and maybe even figure out why even like seasoned investors sometimes panic and act like a herd of cattle.
It's a good analogy.
So the source material for this deep dive is a series of lectures from this economics professor who really breaks down what everyone should know about money and banking.
Oh, cool. Yeah, that should be interesting.
To start with, how are stock prices even determined in the first place? I know these lectures mention something called the fundamentals model.
Yeah, the fundamentals model basically says that a stock's value comes from two things. It's future dividends and the rate of return investors want for owning that stock. So it's like investors will pay more for a stock if they think they're going to get bigger dividends later on or if they think the stock is less risky.
You got it. The professor actually gave a really cool example. Imagine a company is earning a 12% return on its capital. But investors, they only need a 10% return to hold onto the stock.
Okay.
Well, that tiny 2% difference can actually make the share price more than 3 times higher than the company's, book value.
Oh, what?
What it's actually worth on paper.
So that means like a really profitable company can be worth way more on the stock market than what its balance sheet actually shows, right?
Yeah, exactly.
So it's almost like there's this hidden value just from like the potential.
Right. And I think it really shows just how much expectations about growth and future earnings matter for determining stock prices.
But this fundamentals model, it doesn't tell us everything, does it? Like how do we actually know what that required rate of return should be?
Well, that's where the CAPM comes in,
A what?
the capital asset pricing model.
Oh,
It might sound intimidating, but it's actually pretty straightforward.
right.
CAPM predicts the required rate of return by looking at how a stock's performance matches up with the overall market.
Okay, so if a stock tends to go up when the market goes up and down when the market goes down, that means it has a higher required return because it's riskier.
Yeah, exactly. But here's the interesting part. A stock that's negatively correlated with the market,
Meaning?
meaning it goes in the opposite direction, could actually have a required return that's even lower than the risk-free rate.
Wait a minute. Why would anyone want a lower return for a stock that's like going against the whole market?
Because that kind of stock gives you hedging opportunities. By putting it in your portfolio, you can actually make your overall risk lower. It's like insurance against a market downturn.
Oh, I see.
The professor talked about these real-world examples of company betas, which is how you measure this correlation to show how different stocks have different levels of risk, and so they need different rates of return.
Yeah.
He talked about like Duke Energy being an example of a company with a low beta, Google with a higher one, and Las Vegas Sands with an even higher beta because it's more volatile.
Interesting. So even boring stocks that don't follow all the market trends, those could actually be valuable too
Totally.
for a well-rounded portfolio.
Yeah.
Okay, so we've kind of figured out stock prices a little bit. Now let's move on to this idea of bubbles. We always hear about them, but like, what really is a stock market bubble?
A bubble is basically when stock prices go up way faster than what the actual companies are worth. It's driven by all of this enthusiasm and speculation from investors instead of like a rational view of what a company's actually worth. Kind of like a big euphoria, detaching prices from reality.
So it's like psychology is just taking over the market.
Exactly.
Yeah. It reminds me of that example the professor used about the dot-com bubble.
Oh, yeah.
eToys.com. That was valued at billions, even though they had practically no sales and huge losses.
And then you had Toys R Us, which was way more established with a much lower market value.
Yeah, it's wild how powerful those market feelings can be.
And the real question is why these bubbles happen in the first place.
Yeah, why?
It's like they feed on themselves. As prices go up, everyone thinks they're going to keep going up, so more people jump in.
Right.
And then it becomes a self-fulfilling prophecy.
Yeah.
The price increase becomes the news, and that just makes everyone even more optimistic.
So people are buying just because the price is going up, not because the company's doing better. It's almost like a big game of musical chairs where everyone's just trying to grab a seat before the music stops.
Exactly. And that's where this greater fool theory comes in.
What's that?
It's the idea that you buy something, even if it's overpriced, because you think some other greater fool is going to come along and buy it from you for even more.
Wow.
And that's a big part of what drives these speculative bubbles.
That's both fascinating and a little scary. I remember the professor showed that chart comparing the S&P 500's price to corporate earnings during that dot-com bubble, and it was crazy how disconnected they were.
Oh, I remember that.
Like the market was going through the roof, but earnings were barely moving.
Yeah, yeah. That really shows you a bubble in action, for sure.
It makes you think about how to avoid getting caught up in all that hype.
Definitely. That disconnect between the price and what something's actually worth is a classic sign of a bubble.
Yeah.
And it just goes to show that even the smartest investors can get swept up in it all.
All right, so we've tackled stock prices and looked at those crazy bubbles. Now let's move on to something that can be pretty confusing, derivatives.
Yeah.
They always seem to get a bad rap, especially after that 2008 financial crisis. But as the professor explained, they're not necessarily bad in themselves.
I don't know.
They're kind of like tools,
Yeah.
that can be used for good or bad.
Right, exactly. Derivatives are basically contracts where the value comes from some underlying asset or transaction.
So instead of buying a stock directly, you're like making a bet on whether the price will go up or down.
Sort of, yeah. But derivatives can be way more than just bets. They can help manage risk or protect against uncertainty or even give you exposure to all sorts of assets. The professor gave some really cool examples of how derivatives can actually be helpful.
Okay, I'm curious. Give me an example of a good derivative.
Sure, let's take commodity futures contracts.
Mm-mm.
Imagine you're a wheat farmer.
Okay.
You've planted your crop. You're expecting a bumper harvest in a few months, but you're a little worried about the price of wheat going down by the time you can sell it.
Yeah, I can see why you'd be worried about that. All that work, and then suddenly the market changes.
Exactly.
Yeah.
So what you do is you sell a futures contract for your wheat.
Okay.
And this contract locks in a price for your crop right now.
Even though you won't deliver it for months.
Yep. That way you're safe from any price drops. And on the flip side, a bakery that needs a lot of wheat, they might buy a futures contract to lock in a price they're happy with. So they know they'll have a steady supply, even if the price of wheat goes through the roof.
So both sides are kind of hedging their bets, creating certainty when things are uncertain.
Yeah.
I can see how that would be really important for those businesses that depend on those commodities.
Definitely.
The professor also mentioned mutual funds as an example of a good derivative.
Oh, yeah, mutual funds.
I actually use those, but I never really thought of them as derivatives before.
They are. It's basically a pool of money from lots of different investors that's all used to buy a bunch of stocks or other assets. And when you buy shares of the mutual fund, you're indirectly investing in all of those assets.
Oh, okay.
It's a great way to get diversification, which basically means spreading your money across lots of things to reduce risk without having to buy each stock individually.
Right, so you get diversification built in, and you don't even have to be some kind of stock market whiz to manage your investments. That's pretty handy. But I also know derivatives can be super risky, especially the more complex ones. Let's talk about those, what were they called? Collateralized debt obligations?
CDOs.
Those were a big part of that 2008 financial crisis, right?
They were. CDOs are a type of structured asset-backed security that got super popular during the housing boom. They basically take a whole bunch of mortgages or other kinds of debt and kind of slice them up into different tranches,
Okay.
each with a different level of risk and return.
I'm not sure I follow. Can you explain that a little more?
Imagine you've got like 100 mortgages, right?
Okay.
Some of them are probably going to get paid back no problem, but others are riskier. Those borrowers might default.
Right.
Well, a CDO takes those mortgages, bundles them all together, and then creates these tranches based on how risky they seem. Safest tranche, that's called the senior tranche, that gets paid first if any of the mortgages default. And as you go down the line, each tranche gets riskier.
And they offer higher returns.
Exactly. It's like a pyramid of risk with the safe investors at the top.
And the riskier ones down below?
Yeah. The idea is that by doing this, you can turn something risky, like those individual mortgages, into something that seems safer.
Yeah.
But the big problem with CDOs is that they rely on this idea that mortgage defaults happen independently.
Meaning what?
It means that if one mortgage defaults, it shouldn't really affect whether other mortgages default too. But during that housing bubble, well, that assumption turned out to be a big mistake.
Yeah, because when housing prices started going down, defaults started happening like dominoes.
Exactly. And because these CDOs were so complicated and all interconnected, no one could really figure out who was holding all the risk or how much they might lose. So when that housing bubble burst, it set off a huge chain reaction that almost took down the whole financial system.
Right.
The professor said it's a perfect example of how a seemingly smart financial idea can actually turn into a total disaster when the underlying assumptions are wrong.
It makes you think. We try to engineer away all the risk, but sometimes you just don't see those hidden dangers. So we've talked about futures, mutual funds, and even those CDOs.
Mhm.
But what about those other types of derivatives you always hear about, like options and swaps?
Yeah, options are really interesting. They give the holder the right to buy or sell an asset at a set price within a certain time, but they don't have to. It's like putting a reservation on a stock.
Oh, so it's like having a rain check for a stock. You can decide later if you want to buy it based on whether the price goes up or down.
Exactly. There are two main kinds of call options, those let you buy, and put options, those let you sell. So let's say you think Tesla stock is going to go up in the next 6 months.
Okay.
You could buy a call option for Tesla, and that gives you the right to buy shares at a certain price.
Even if the market price is way higher.
Exactly.
So if Tesla stock does go up, you can use your option, buy those shares at that lower price, and make a profit. But if the stock goes down, you just don't use the option, and you only lose what you paid for the option itself.
You got it. Options are a way to potentially make your returns bigger.
But they also come with more risk.
Exactly. And then you've got swaps. Those are agreements between two parties to swap cash flows based on some underlying asset or index. Like a company might use an interest rate swap to protect themselves from rising interest rates.
So derivatives, they're like a whole world of their own, with everything from those simple futures to those super complicated CDOs.
Absolutely.
They can manage risk, you can speculate on prices, you can even get involved in different types of assets.
The main thing to remember is that derivatives are just tools. You can use them responsibly to make things more stable, or you can be reckless and make things way riskier. Understanding how they work and what the dangers are, that's really important for navigating those complicated financial markets.
Okay, so we've talked about stock prices, those market bubbles, and even all those derivatives. But what about government regulation? How do they try to make the financial system safer and prevent those huge meltdowns like back in 2008?
That's the big question, isn't it?
Yeah.
It's kind of like walking a tightrope. You want to create a space that's safe and stable for everyone involved, but you also don't want to hold back innovation or stop the flow of capital. Those things are super important for the economy to grow. It's a tough balance to strike.
So how do governments actually find that balance? What are some of the things they do?
Well, one of the most common tools is deposit insurance. Like in the U.S., we have the FDIC,
Well, what?
the Federal Deposit Insurance Corporation. It basically insures deposits up to $250,000 per account.
Oh, right.
So that kind of safety net helps stop those bank runs, where everyone freaks out and tries to take their money out at the same time
Yeah.
because they think the bank's going to collapse.
Right.
And that kind of panic can actually cause a bank to fail.
So if you know your money's safe, even if the bank goes under, that gives you some peace of mind. But doesn't that also cause problems? Like if the banks know they're protected, wouldn't they just take on more risk?
That's a great point. It's what's called moral hazard.
Moral hazard.
Yeah, if you protect someone from the consequences of their actions, they might take bigger risks.
That makes sense.
So to counter that, governments have all sorts of rules about what banks can and can't do.
Okay.
Like they might limit what kind of assets banks can own or what types of loans they can make.
So they're trying to stop those really risky bets.
Exactly. One historical example is the Glass-Steagall Act.
Glass-Steagall.
Yeah, it was in place in the U.S. for decades. It basically separated commercial banking, where regular people keep their money,
Right.
from investment banking, which is all those riskier things like underwriting securities and trading in the markets. The idea was to protect people's money from those big bets.
That makes sense. Did it work?
That's up for debate. Some people say it prevented those big banking crises for years. Others say it actually made the banks riskier because it forced them to focus on a smaller range of assets. It kind of shows how even those well-meaning regulations can backfire.
Yeah, it's a complicated system for sure.
It is. And the financial world is always changing, so regulators are always trying to keep up.
Sounds like a tough job. So what other things do governments do to keep things in check?
Well, capital requirements are another big one. Basically, banks have to keep a certain amount of capital in reserve.
Like a safety cushion.
Yeah, kind of like a rainy day fund. That helps them absorb losses if loans go bad, so there's less chance of a bank failure.
So it's like an airbag for the banking system, huh? Might not prevent all accidents, but it'll definitely soften the blow.
That's a great way to put it. And because banks have to put up more of their own money, it makes them more careful about who they lend to. Another thing is the chartering process. Before a bank can even open, They need permission from the regulators. So that helps make sure that only institutions that are financially sound and have good management can operate. It's kind of like getting a driver's license. You got to prove, the rules of the road, and you can handle a car safely.
It's like protecting the public from reckless drivers, but in this case, reckless banks.
Right.
What else? Are there any other important parts of financial regulation?
Transparency is huge.
Like being open about what they're doing?
Exactly. Regulators make banks follow strict accounting rules and make them share information about their finances publicly. That way, investors, depositors, everyone can see what's going on and get a sense of how risky they are.
It's like shining a light on how the system really works so we can all make better decisions and hold those banks accountable.
That's exactly it. And that 2008 crisis really showed us what happens when there's no transparency, especially with those complex things we talked about, like CDOs, when they're kept secret.
It's all about trust, right?
Absolutely. Transparency builds trust in the whole financial system and helps prevent those hidden risks from causing trouble. So I guess we've come full circle. We started with stock prices, then those market bubbles, then we dove into derivatives, and now we've looked at how governments try to make the system safer.
Wow, that was a lot.
It really shows how all these pieces fit together, how people feel can drive those market bubbles. Then you get those complex derivatives, and that can make the risks even bigger, so the regulators have an even harder time controlling things. It's a system that's always changing.
And what does all this mean for our listeners? I guess the main thing is, to be a smart investor, you need to understand both how the system works and how to avoid those psychological traps and those big systemic risks.
I think that's a great takeaway. By understanding how stock prices are determined, how those bubbles happen, how those derivatives actually work, and how governments try to keep things safe, you can make better decisions for yourself and hopefully not get caught up in the herd mentality when things go south.
Great advice. Thanks for joining us for this deep dive into the world of finance. It's been fascinating and a little scary at times.
It has.
But the more you know, the better you'll be able to navigate the markets and achieve those financial goals.
Yeah, absolutely.
That's a great note to end on. Thanks again, everyone, for listening, and we'll see you next time on The Deep Dive.